Hey everyone, this is Brianna from Experian, and today I'll share with you steps to take to qualify for the best mortgage rate. A lot of factors that influence your mortgage rate are out of your control, like market conditions or your lender's policies. But you can influence certain factors. Here's how. First, improve your credit score. You can qualify for a conventional mortgage loan with a credit score of 620 or higher. But the lowest mortgage rates are generally reserved for people with credit scores in the mid to upper 700s. To increase your credit score and lower your rate, first check your Experian credit report and your FICO score to see where you stand. Then take these steps. Pay all your bills on time. Pay down your credit card balances. Limit the number of new accounts you apply for. And finally, pay off any accounts that are in collections. Next, maintain steady employment if possible. Lenders like to see that mortgage applicants have been in the same job for a while, because a consistent employer likely means that applicants will have the means to make their loan payments on time, and that in turn could get you a lower interest rate. So if you can, stay in the same job for at least 2 years before you apply for a mortgage. Next, make a bigger down payment. The more money you put down, the lower your loan will be, and likely the lower your interest rate will be. So while it's often cited that 20% or more is the best down payment to make, you often don't need to make that much in order to qualify for many mortgage programs. That being said, the more money you can put down and the closer you can get to 20%, likely the lower your interest rate will be and the more money you'll save on interest over time. You can also apply for special programs and discounts. Government mortgage programs like FHA loans, USDA loans, and VA loans all generally come with lower interest rates for applicants, along with other special features. Also, if you apply for a loan through a bank where you have an existing relationship, you may be able to get an interest rate discount. Next, pay mortgage points. Paying mortgage points, also called discount points, is a way of paying prepaid interest. So you can get your mortgage rate down by between 0.125% and 0.25% for every 1% of the loan amount that you pay up front. Because the upfront charge can be high, it's important to do a break-even analysis. That means making sure that you'll stay in the home long enough to recoup the cost of paying any mortgage points you've chosen to pay for upfront. Next, choose a shorter loan term. If you can afford it, go for a mortgage term that's 15 years instead of 30 years, because that often comes with a lower interest rate. And finally, compare loans from multiple lenders. You can get pre-approved with 3 or more lenders and then use those offers to negotiate with each lender to get a lower rate overall. For more on how to strengthen your mortgage application and get the lowest interest rate you qualify for, check out the link in the description box. See you next time.